Welcome back to Financial Clarity for Doctors, everyone. This is Rachelle Vanderzanden here with Corey Janoff.
I'm here too.
Woohoo! Yeah. Today, we're going to talk about return expectations. Like, what do we think is going to happen in the stock market? Honestly, returns vary a lot from year to year. We don't necessarily know what's going to happen next. And I think the best advice is generally expect the unexpected. Like, you just don't know what's going to happen. But outside of that, what's a realistic expectation of where returns might land? Like, what's the range that we're looking at? It does depend quite a bit on the type of investments that you're holding and how aggressively you're invested. Like, are we mostly in stock-based investments? Or are we mostly in bond-based investments? That can affect it a lot. But today we're going to walk through a few different types of investments and a range of expectations for how those different types of investments can potentially perform. It's pretty much stocks and bonds that we're going to talk about today. We're not going to talk too much about alternative investments. We've had a couple episodes about alternative investments specifically, like real estate and private markets. But today we're going to talk about the S&P 500, international indexes, bonds, and what like a combined portfolio might look like. And we're just going to give you some good historical context for all of that.
And as you've heard before, past performance does not correlate or does not indicate what future performance will be. I would also keep in mind, like, with growth numbers, like in order to sustain that same, hypothetically, if something's growing by 5% a year every year, all right, going from 100 to 105 is a lot easier than going from a billion to a billion. And what would that be? 50 million would be 5% of a billion. Is that right? Yeah. So that's adding 50 million is a much bigger hurdle than adding five. Whatever your, if we're using dollars here as the thing we're talking about. So keep that in mind. It's, wouldn't be surprised if returns in the future are a little bit more muted. Also, we cherry picked some of the most efficient and best performing assets throughout history, also the ones with the most readily available data.
Mm-hmm.
If you truly do have a well diversified portfolio, it's not going to look exactly like this. Also, these return figures assume money was invested on day one and left forever. That's not how you guys are doing things. You add money like every paycheck or every month throughout your careers. So
And maybe
you're
take money out at some point,
and maybe take
like,
money out periodically.
yeah,
You got to
definitely
buy
when you
things.
retire, but along the way, some money may come out of there as well.
Yeah, there might be some months or years where you don't make any contributions just because life happens.
Hmm.
So y your accounts are going to behave differently than what these arbitrary indices do and what these numbers we're going to throw out do. So try not to benchmark your specific circumstances against some arbitrary index because it's not a good strategy. I think the also other thing to note is that it's rare that you will experience an average year. We'll give you some average numbers, but we'll also give you like the highs and the lows, and that's more the norm than the expectation. So if we said, hey, the historical average is 7%, well, rarely was there ever a year where the thing did 7%. It was either well above or well below that, but the average is just the sum of all parts divided by the quantity. So where do we want to start? Maybe the most commonly referenced one, the S&P 500.
Yeah, I think that's what everyone tends to measure themselves against, which is kind of unfortunate because that's not usually what you're invested in. But the S&P 500 is like the 500 largest publicly traded companies in the US, basically. Like that's a general guideline of what that is. Um, so you can't directly invest in the index necessarily, but they like investment companies have created mutual funds and ETFs and things like that that are designed to track the index. Those didn't even really exist until the 1970s and didn't become widely available until the 2000s. So it's only recently that we can even kind of invest like what these indices are showing us the performance has looked like. So it's a little funky, but it's our best way to kind of look at long-term performance is using these indices. The tracking error was also more significant earlier on. So we have data for the S&P 500 back to the 1950s, But, it may be that those early numbers are not super accurate. They're just the best ones that we have available.
And
And it's
also, if
gotten a
you're
lot better. Yeah.
with the tracking error, it's like how closely does your investment replicate what the index actually did? And
Hmm.
it's gotten way more efficient as time's gone on. But in early days, like it was going to deviate a little bit. Now, like it's super precise. Like it
Yeah.
mirrors the index like
All the
clockwork.
algorithms and all the
Yeah.
things, they're doing a lot better job than whatever we used to try to do before, which
So
honestly, not when I was even born.
yeah. So most S&P 500 index funds replicate the S&P 500 identically minus their expense ratio. So whatever the index return is minus the fund expenses is what the fund is going to return today. But initially that wasn't really the case.
Hmm.
So keep that in mind. Like no one invested in an S&P 500 index in 1950 because one, it didn't exist. And two, that would have been more or less impossible to replicate unless you literally bought all 500 stocks yourself through a
It
broker,
would
which
have
would have
been
been
impossible to
very
replicate.
costly to do.
Yeah,
Like
so
back
much time
then,
and energy.
you bought like the Nifty 50, like if that, you just bought some of the big names and held on to them forever.
Hmm. Yep, totally. So the data that we're looking at right now is with dividends reinvested. So, and that's not necessarily how people always invest it either. So some big companies can return to their shareholders dividends, which are basically like a share of the profits. And a lot of times when you are investing in these funds like the S&P 500 index funds and things like that, it's kind of automated that we reinvest those dividends. And so that's part of the growth numbers that we're looking at. So that growth includes both the stock price appreciation, so the increase in the stock price, and those dividends that were reinvested, which basically means you have more shares than you did when you started. So when we're looking at that for the S&P 500 specifically, the annualized total return from like 1950 to the end of 2025 was like 11.68% versus 7.9% if we didn't reinvest dividends. So that's kind of an important part of the strategy is if your goal is really growth, obviously we don't want to take those dividends and not have them reinvested. We want those to be reinvested, and that's like your best chance of getting the highest rate of return.
And most of you
Um,
should automatically have
yeah,
dividends
I think,
reinvested. That's pretty much the default setting for
and
all
you'll know
custodians.
if you're not getting your dividends reinvesting, like either it shows up as cash in your account or maybe you get a check. And sometimes retirees may do that as a source of income. But again, generally, like that's how we approach things now. We reinvest dividends. The best decade that was noted from 1950 through like the 2020s and even that like 5 year stint from 2020 to 2025 was actually the 1950s. So in that decade, the annualized return was 19.35% for the S&P 500 and the cumulative growth, so for that entire decade was almost 500%. It was like 486% or something like that. That's totally wild. And that was just this whole post-war boom. Like obviously the US economy was growing substantially in that time period, and that showed up in the stock market. The best year was in 1954 when there was like a 52 plus percent return and was accompanied by a massive surge in the economy. And then the worst year was 1957, which was one of the few negative years. Maybe there was only one in that decade. I don't recall, but it was negative 10.78%. During like President Eisenhower's tenure, there was like a recession. But again, like the cumulative growth, if you were invested in that decade, was huge. Not as many people were participating in the stock market at that point in time, so the people that actually benefited from that is much lower a percentage of the overall population than it would be today. But obviously, like a really great year for the US stock market.
Yeah, and I keep and yeah, like you said, 1950s GI Bill, people had money, people were buying stuff. It was like the first introduction of credit cards, so people were buying stuff on credit. So a lot of companies benefited this. Now, for investors, just did some Googling. Only 4% of individuals owned publicly traded stocks back in the 1950s. So,
But maybe they had a pension, and maybe like
and those
the
pensions might
pension
have
was
invested
doing
in
well,
stocks. Yep.
Yeah,
Yep.
maybe. Who knows? Yeah.
But in terms of individual stock ownership, it was few. Today, it's like two-thirds of people own stocks, which is amazing. Like the
Hmm.
majority of Americans are participating in the best growth engine that we have generated as humans,
Yeah.
which is the stock market. Um,
Hmm.
so it's But yeah, so some of these
Different,
numbers again,
different times.
most people weren't participating. Most people also didn't throw money in 1950 and let it sit until the end of the decade. Again, like they may have, bought over time as they earned money. So, um, next best decades after the 50s were the 80s and 90s. So 60s and 70s were a bit of duds. We'll cover. Do we even put those specific numbers in here?
No, I
I
don't. Yeah,
can.
there's too many decades to cover, but it was like,
I know. I could rattle
a,
through them really
yeah.
quickly here. We had let me go back up. That's bonds. IFA. We're going through a bunch of data here for you data nerds. Yeah, 60s were 7%, 70s were 5%. Um, with
Average
dividends
annualized
reinvested. Yeah, average
returns. Yeah.
annualized return. So weren't quite as good. We had some recessions there. Inflation was high in the 70s. Anyways, but yeah, 80s and 90s, it was awesome. S&P returned 17 and a half and 18% respectively per year. Uh, the best year in the 80s and 90s was 95 with a 37% growth rate. Start of the dot-com bubble, launch of Windows 95. We only had two negative years in the 80s and 90s, both with less than a 5% decline. Even in 1987, Black Monday, where the stock market was down 20%, it still finished the year positive. That's something that if for those of you history buffs that are like, oh, 1987 stock market crash, well, the year was still a positive year, even though we had one day that was insane. Um,
Hmm.
and then yeah, following the 1990s, the lost decade, we had the dot-com bubble burst, the housing bubble burst, great financial crisis. The US stocks actually lost money on an annualized and cumulative basis from 2000 to 2009. End of 2009, 4 out of those 10 years were negative. We had a good run from 2003 to 2007, but obviously 2008 was pretty bad at minus 37%. Cumulatively from fall of 2007 to spring of 2009, the S&P lost 53%. So quite the downside, worst downside since the 1930s. We didn't go all the way back to the 30s. We started with this data with post World War II numbers simply because the economy was totally different back then. Regulations were different back then. So we figure let's try to focus on a little bit more modern history. Um,
Hmm.
so that's where we picked. 2003 was the best year at almost 29%, coming off of 3 straight years of negatives, 2000, 2001, 2002, which would have been painful as an investor to go 3 straight years,
Absolutely.
see your
Hmm.
your investments go down. But that was only if you invested in US stocks. We'll get to some other asset classes here shortly and why diversification is important.
Yep.
Um, but throughout history with the S&P 500, about 75 to 80% of years are positive, depending on what your starting point is for which years you're looking at. The average positive year in the S&P 500 is about a plus 20% year. So when the stock market's up, it is up. You're getting double digit returns typically. The average negative year is about negative 14%. So when the stock market's down, it's typically
It's
down.
down. Yeah.
It's you're not getting like, oh, this year I'm plus 7, next year I'm minus 5. That doesn't happen. It's, now so there are some single digit down years, I would say. Like in the last 15
Yeah.
years, the down
It
years have
happens.
been a bit modest, 2022 being an exception of, I think, minus 20 something percent.
Hmm.
Um, but you do have some single digit down years that are with the weighted average from the negative 30s and plus negative 40s in some cases, that they drag that average down further. But yeah, I think another thing to note, almost half of the total return over the last 75 years has been from reinvesting dividends. So again, it should be the default for all of you, but
Hmm.
make sure you reinvest your dividends.
Yep. So if we look at the S&P 500 in comparison to the international index, which the main one we have is the MSCI EFA, so it's like that's generally developed stock, right?
Yeah, correct. It's
Yeah.
Europe, Australasia, which is Australia,
Yeah.
New Zealand,
Japan.
Singapore, Hong Kong, Japan. So all the
Yeah.
developed economies in
Gotcha.
the Far East. So, but yeah, I think it's 21 countries, and then I threw in some emerging markets data next, but that doesn't go back
Yep.
quite as far. And this
Right.
one we
Yeah.
only have back to 1970 because again,
Exactly. So we
data.
don't, even with this, we don't have data that's like as long, like far back as the S&P 500, but still we can kind of compare some of the decades we just talked about. So the overall average from 1970 to the end of 2025 was like an 8.89% cumulative or not like annualized return. And then we can compare some of the ones we mentioned above. So the 1980s were a great decade for everyone. Everything was up. So international stocks or developed international stocks at least were up an annualized rate of like 22%. And then the S&P 500 was up 17.5%, just as a reminder. So it actually did better than the domestic stock market. That's a cumulative growth of 630% for international versus a little over 400% for the S&P 500. So again, great for everyone, but kind of, noticeably better for the international markets in that decade. The 1990s were a little lackluster for international markets, especially when you compared it to domestic markets. So the annualized return for the developed international markets was 7% versus over 18% for the S&P. Like that's a huge difference. The developed international markets just didn't benefit from that dot-com kind of bubble as much as domestic markets did. And then in the 2000s, foreign stocks kind of held their own, although they didn't do great. Like it just wasn't a good time for stock-based investments. But the developed international had like a 1.5% annualized return, like 16% cumulative over the entire decade versus the negative returns that the S&P 500 experienced. Um, yeah, there are the two best years for developed international were 1985 and 86, which saw 56 and 69% returns, which is wild to have those 2 years back to back. That is huge. And then 1974 and 2008 were the worst years at negative 23% and negative 43%. So that 2008 year was even worse for developed international markets than it was for the S&P 500.
Yeah, so for developed economies, US included, the 2010s were rough, but if you invested in emerging economies during
Woo-hoo.
the 2000s, um, or excuse me, yeah, the 2000s, not the 2010s. So 2000 to
Mm-hmm.
2010, you did quite well in emerging markets, averaging over 10% a year, 162% cumulatively, including a plus 76% in 2009. 2008 was rough for everyone. That was minus 53 for emerging markets. Um,
Mm-hmm.
but again, be diversified because even if some areas are doing poorly, others might carry the weight and do well. So for all those
Mm-hmm.
investors that either lost money or didn't see any growth because they only own domestic stocks, if you had had some emerging markets in your portfolio, you probably would have done all right. Or if you had been dollar cost averaging over time, like we talked about in a previous episode, buying periodically at consistent intervals, if you'd been rebalancing, so trying to keep your target percentages in line, which we'll talk about a blended portfolio here in a little bit. Even though it wasn't the best decade, you still would have seen some positive growth in the 2000s. Emerging markets all over the place. Data only goes back to 1988 for publicly traded stocks. Um, do I have, yeah, from that time period, averaging almost 10% a year, only 6.5 without dividends reinvested. So again, reinvest those dividends. And this is fun. The two best years for emerging markets, 93 and 2009, plus 75% and plus 76% respectively. The two worst years, negative 53, like we talked about in 08 and negative 31 in 2000. So if you're in emerging markets, it's a roller coaster ride,
Yeah.
but you got a lot of growth potential in those emerging up and coming economies, but they can also get hit pretty hard if things rock the boat. There's a lot of political risk there. There's a lot of currency risk there,
Mm-hmm.
infrastructure risk. So it's a lot of risk reward, a lot of opportunities, but a lot of potential for things not to pan out as hoped. But
Yep.
a good diversifier from your more traditional, quote unquote, stable economies and investments, and a nice portion of a portfolio. You don't want to put the whole portfolio in emerging markets, but 5 to 10% wouldn't be a bad idea.
Yep. Yeah, that's why we like to encourage people to like participate in markets like that, but not overly so. Like you don't if you have all of your portfolio in emerging markets and you lose like 53% and 31% and those 2 years are in the same decade, like that's brutal. Like that's not we don't want to be all in on those kinds of things. But we do want to be able to participate in positive 75% returns at a single year. Like that's wild too. So definitely one of those things where it's like a little bit can be helpful. Bonds are kind of the opposite of that emerging market volatility, where they're just kind of trucking along, doing their thing, nothing exciting going on here. And we do have data all the way back to the 1950s. Again, like just better data for us here in the US, just having some of this history all the way back. Historically, the average annualized return is much lower. So like 5.5% versus I think it was like 11.5% for the S&P 500. And the bonds generally are always going to underperform in like the good stock market years. So if the stocks are up 30% or whatever, like bonds don't really have the capacity to do that. They're just limited by the way that they're structured. So in the 1950s, the average return was 1.9% per year for bonds versus, over 19% in the S&P 500. So, probably one of those years where you maybe regret being in bonds or one of those decades. And then the 1980s was another good year for the S&P 500. The average return for bonds though was 12.5%, partially because inflation was so high. So the interest rate and the yield on bonds was also quite high because of that. And that was versus, like 22% international annualized return and 17.5% in the S&P. So again, like those are good years for bonds and international stock and domestic, like large companies. But like with the bonds, there's probably significantly less volatility, like lots of less ups and downs, although like there were very few downs in those years, as we discussed earlier. Um, yeah, in the 1990s, there was an average of like a 7.7% return on bonds versus 7% internationally and 18% in the S&P. So again, kind of like underperformed US stock, but outperformed international stock a little bit. And then the decades where bonds shined was really the 2000s. Like we just didn't get a ton from developed international markets and from the US stock market, but bonds actually had an average return of 6.3% versus like 1.5% for developed international and, a negative 1% in the S&P. So that was the year where it was like hindsight being 2020. If you're going to retire and it's 2008, hopefully not all of your money is in stocks. Hopefully you have some money in bonds because obviously that was a year where we heard a lot of news about people losing their nest eggs and not having a well enough diversified portfolio that they were protected from that. Yeah. Tell us more, Corey.
Yeah. If we wanted to do a more diversified strategy, and we did in this, I just made up this portfolio: 45% S&P 500, 15% EFA, developed international, 40% ag. So a little spin off of the traditional 60-40 stock to bond portfolio. Now, most of you listeners probably have a little bit more aggressive in stocks as you're early on in your career. 60-40 is kind of a classic retiree portfolio. When you're starting retirement, all right, 60-40 is kind of a good, let's start here, maybe adjust as needed based on circumstances. And you might end up getting more conservative as you get further along, but it's a commonly used strategy there. So best years for a 60-40, globally diversified portfolio. Again, no emerging markets because of lack of data history, but best years would have been 1985 at plus 31% and 1995 at plus 27%. Worst years would have been 2008 at minus 21% and 2022 at minus 15%, which is kind of a little bit of a head scratcher. What? 2022? That was one of the worst years on record for diversified investors because both stocks and bonds were down double digits that year. So being diversified and having bonds didn't really help you in
And I think
2022.
that's the only year that ever happened, right? Like
It might, I think it's one
double digit
of,
down. Yeah.
it might be, I think it's only one of 3 years on record where both stocks and bonds were down the same time. It might have been
Yeah.
one of three where they were down double digits, but anyways, still, but that's
Yeah.
pretty good. I mean, look at this. Your worst years by being diversified were minus 21 and minus 15. That you can handle. You can stomach that. That's not a
Yeah.
minus 50 or a minus 70 return. And the
And like in
annualized
2008, like the strategy would have been like, okay, like if you need income to live off of, we sell our bonds because they're actually up a little bit. Sure, your whole portfolio is down 21%, but we can be strategic about how you withdraw money if you're in that situation. And you can, just withdraw from the asset classes that are down and leave the rest to recover. And that's the whole point of having another reason that a diversified portfolio is very helpful to have. Yeah.
for sure. Um, Now, here's a fun little bit of cherry picking. So we're recording this while the stock market's at an all-time high, which makes the numbers look better. If we were doing this when the stock market was down a bit, like let's say we were doing this at the end of 2022, after a rough down year, S&P 500 from 1950 through 2025 was almost 11.7% annualized. Well, if it was through the end of 2022, it was about 11.2% annualized. 11.2, 11.7 rounding error. That's, a half a percent, but a half a percent compounded over 75 years. So cumulatively, if you threw $1,000 in 1950, it would have grown to almost 4.5 million by the end of 2025. If you threw $1,000 in 1950 and looked at that account balance at the end of 2022, it would have been about 2.3 million. So $2 million less is what a half a percent over 75 years compounds to.
But that's like if you get the same return every single year. And like it's just, yeah. I mean, again, like it's really funky how
Well,
data
no, that would
works
have
and
been
how,
the cumulative. So taking all those individual years added up, we just
got
take
it.
the last 3 years off of the equation.
Got it.
At least that's my understanding. But again, I'm not doing a deep dive in the forensic of Google Gemini's data sourcing for me. So all this data we're talking about could be wrong. We're relying on Google to give us some of these answers. But honestly, it's not too far off from other stuff that I've seen.
Well, and I think
That's
the lesson is the same.
yeah. So the point is like your starting point, your ending point can really affect the quote unquote performance figures and skew the numbers. And I'll have this conversation with clients occasionally. It's like, hey, yeah, your accounts look great today. If we were having this conversation 2 weeks ago, it wouldn't look as great, or vice versa. Hey, today it doesn't look as good than if we had this meeting 2 weeks ago because we just had a 10% slide the last 2 weeks and it's making everything look a lot worse than it was 2 weeks
Hmm.
prior. So that's part of
Yep.
investing. Like you don't want to focus on the day to day, week to week, year to year. I mean,
A single point in time.
even
Hmm.
decade to decade, it can be wildly different. So we've been spoiled the last 15 years with, aside from 2022, phenomenal returns. In at least in stocks, bonds have been not quite as strong. They've done all right the last several years as interest rates have been higher. But yeah, it's been great for stock investors over the last 15 years. We haven't really experienced a major downturn where people in the 60s and 70s, or people in the 30s were pretty scarred. People in the early 2000s, they got burned over a 10-year span. They got burned twice. Um,
Hmm.
so we got to keep that in mind as investors. We're in it for the long run. Numerous decades for most of you. Like it's hopefully you're invested for 50 plus years. Like for many doctors, all right, we start saving and investing in our 30s for most of you because you don't really get your first real job until then. Um,
Yep.
and hopefully you live a long, healthy life into your 90s. So that's like a 60-year time span. You're going to have good years and decades. You're going to have poor years and decades. But if you're diversified, if you rebalance, if you reinvest your dividends,
Hmm.
um, hopefully it all works out in the long run. But no
Yeah.
guarantees of what the future is going to hold. Who knows if it'll be similar to the past? But, we've got a good weighty evidence of history here to show us things can fluctuate from time to time. Um, but as long as there's people on this planet, we need to buy things, we need to provide goods and services for each other. So there's opportunities for companies to deliver those goods and services to the population, and therefore opportunities for investors in those companies to benefit. And
Yep.
you are those investors.
Just be prepared for the wild ride that it will be. Like I think that's the biggest thing is just expect the unexpected and know that it's not going to be smooth sailing from now until retirement.
And you'll probably never have a average year
Hmm. Maybe once, maybe one time.
if you're lucky.
Yeah. Okay. Thanks for listening, everyone.
We'll see you next time.